Greetings, everybody. Happy fall. It's Chris Karam here with Finspire, Chief Investment Officer. As this quarter, as we do our Focus on the Market series, we're going to guide you through the corn maze. Now, every fall, it's a great time to go through and take your family, get some friends, get to a good pumpkin patch, maybe have some of the older kids scare the younger kids at the corn maze. But when you get through to the other side of the corn maze, a good one will have real high corn stalks. There'll be tough visibility, tough to see over them, and a lot of dead ends. And I feel like this year, 2022, has been a corn maze in the capital markets. But we're going to walk you through it because we're going to show you how to get through the other side of that corn maze and what the capital markets are offering today and how to play it moving forward as we not only do a recap on the third quarter, do a look forward into the fourth quarter and into 2023. All right, so let's get into the corn maze. Here we go. All right, let's start with corn. Why not? It's a dedication to the corn maze, so we're going to start with a very economically important commodity of corn. And as you can see, throughout 2022 and 2021, commodities really surged. Corn has been one of the better performing commodities out there. So whether it's for food, for feed, or for fuel, corn is a particularly important commodity that has seen a run-up in price like many other commodities and exhibited all that volatility tied with inflation. How did we get here? So just purely from a stock market perspective, it's really important to take a look back, and because as we go through tightening financial conditions so far in 2022 with rising interest rates and the money supply being drawn down by the Federal Reserve, what we have to recall also is how we got here in the first place is by injecting trillions into the marketplace, into the capital markets back in early 2020. So the trillions that were injected both from the Federal Reserve, central banks around the world, and also the Congress, U.S. Congress, that money now is starting to dry up and being withdrawn from the system. Even with all that, despite our big drawdown in the equity market this year, since the COVID peak, you can see we're still up around just shy of 6%. We were at the end of the third quarter. If you were to just take it from where we were at the peak of COVID to today. So all of this is shaking out. But really from here, it's how do we move forward? Well, when we take a look back of the returns over the first 3 months of the year in 2022, first 3 quarters of the year in 2022, commodities have led the charge. Okay, commodities are up around almost 14% as a broad basket index for the first 3 quarters of the year. Right behind that is fixed income, and fixed income has been a disappointment from a total return perspective with rapidly rising interest rates. We've seen returns in fixed income that we haven't seen in decades, perhaps ever. Minus 14.4% in core bonds, just reflecting the rapid rise in interest rates over the first 3 quarters of the year. Now, that being said, bonds still have handsomely outperformed stocks by almost 9% or more, depending on the stock bucket, whether it's the S&P 500, small caps, international equities. So although bonds haven't performed positively, which you typically expect in an equity market drawdown, they have played the diversifying role as the equity market had its swoon, especially with a poor performance in the third quarter itself. So there are opportunities. We'll get to that in a moment. Okay, the labor market. The labor market's a bright spot. In fact, we just got the September jobs report last week. It showed a reduction in the unemployment rate. But one of the things that the Federal Reserve is looking for 2 different things with their interest rate policy. One, they want to control inflation in order to stop raising rates at the speed at which they're doing today. The second is to see this spread between the number of jobs available and the number of people looking for jobs, for that gap to close. And these job openings, which were 11.2 million in July, shrunk recently to 10.1 million job openings. Now, that's a step from the Federal Reserve's point of view in the right direction. You never like to hear about jobs being withdrawn from the marketplace, but that's a step in the right direction from the Federal Reserve's lens, which is used to make interest rate policy. We'll see. There's still a huge gap between the number of available jobs and the number of people looking for work, and that gap the Federal Reserve want to see that gap close a little bit farther. And the unemployment rate still very attractive, still strong labor market, and that may help us actually get through or avoid potential recession. All right, here's why, and that's because we segment, or I should say the Institute of Supply Management, or the ISM, does this monthly survey of activity, and they split the economy into manufacturing and non-manufacturing or services sector in a broad brush. And one of the things that we found is they have this index that anything over 50, which is this dotted line going across, everything over 50 measures is an indicator of expansion. Anything below 50 is an indicator of contraction. And in the September figure, the manufacturing figure fell below 50 to indicate contraction, but the services sector stayed well above 50 to indicate continued expansion. And that actually could have a real positive impact on GDP in the third quarter. It could be positive in the third quarter instead of negative, like we've had the last 2 quarters of GDP contraction. We'll see. But the strength in the services sector, coupled with the strong labor market, could get us through this. That even if we enter a recession, it may not be as deep or as painful as the Federal Reserve has used the word pain, which we don't like in the recent past here. But that could get us through to the other side. The other area that could get us through, where we could start seeing the light towards the end of the path of this core maze, is earnings. Earnings are going to start to be released right about now for the third quarter. And it's not just always about what the earnings recorded were in the third quarter, but companies always give their forward-looking guidance, or usually give forward-looking guidance. And that will help us determine whether or not the equity market has reached a level that was just too oversold based on the current earnings and the forward-looking earnings, or if the lower equity valuations have been justified, based on earnings forward-looking decaying based on a weakening economy. We'll see. But it's very possible with some good earnings reports that we could get a nice bump in equities. All in all, though, this is still an inflation and interest rate driven and reactionary environment. We had too much candy, too much of that candy corn. That candy corn's pretty good. Too much candy in the economy through economic stimulus, not just from here in the U.S., but global central banks and Congress and global legislatures plowing money into the economy. Well, eventually that was just too much sugar for the economy to handle, and now we're coming off that sugar high. Now, good thing is that we're off the peaks of the inflationary figures that occurred back in June. We've seen now 3 straight months of lower figures than that peak, which is good. We still want to see those numbers come down, but they haven't been coming down at a rate that's as fast as the Federal Reserve would prefer, which means they're probably going to stay on the gas of raising rates at least for the next couple meetings. But we'll see, because if those inflation numbers start to turn downward at a more accelerated rate, then you may see the Federal Reserve back off, and you could see a big equity market rally as a result. To give you a sense on how the Federal Reserve is playing this, and I just used one simple metric here, which is mortgage rates as a measure of interest rates being higher. Housing is a big part of the economy, and when you take mortgage rates, which were almost below 3%, or maybe even a little bit below for 30-year mortgages as recently as a year ago, and now it's 6.7% at the end of September, and actually in early October they eclipsed 7% at one point for the average 30-year mortgage rate. You can see you naturally would experience a very large reduction in home purchases, and because they're just simply not as affordable as they were a year ago. And this eventually is going to curtail the growth of real estate prices. That we see some data that's already occurring, and eventually start to see real estate prices fall, which will help control inflation moving forward. But just in one interest rate here, you can see the impact that higher interest rates can have on our daily lives. All right, what are we going to do about it? Let's play offense in a defensive market. Look, interest rates have been higher. We know that. With that comes higher yields in fixed income. With that becomes opportunities that we haven't had in a very long time. So I'll touch on that in a moment. If you have cash on hand, if you're an individual, if you are a corporation and you are trying to put a cash strategy together, this is a great time to put a balance of liquidity, capital preservation, and yield together with stepping very little far out in the risk area to capture sizable or pretty attractive yields compared to where they've been over the last 15 years. Money market rates, just to give you an example, are often yielding north of 2.5% today, closing in that 3% mark. And there are some opportunities even to be very conservative and still get yield in a cash-based portfolio. And lastly, the equity market, right? The equity market's down. What are you going to do about it? Well, there's a great opportunity here to start legging into equities, moving more into equities, especially ones that have competitive advantages in their field, are selling at a discount, that generate a lot of free cash flow, and maybe even offer a dividend yield to get you through that period of time as the equity market remains volatile before those equities rally. And we know from history tells us that equity markets tend to rally before the economy or as the economy is bottoming out through its stage. And so oftentimes it's maybe a little bit too late to jump back in, or you get in later than you wanted to when the rally occurs because maybe you didn't see it coming. And that happens sometimes, oftentimes in the equity market. All right, so here's a snapshot of those yields that I was referring to and how we can embrace them today. Even over the last 15 years plus, we just haven't seen opportunities like this in the fixed income universe. Treasuries on average for the U.S. Treasury Index 4.1% as of the end of the third quarter. Investment grade bonds 5.7%. These are mid-single digit returns. And if you wanted to take some credit risk, you can even go out in the high yield area, which is the U.S. Corporate High Yield Index yielding at 9.7%, which is well above the 15-year average. But there's some caution there because we may be stepping into slower or recessionary type economic environments, which may see those yields jump even higher than that. Nevertheless, good time to tiptoe in and get an established position in some of these different areas of the bond universe just to capture those yields as a way to start embracing them and playing offense in this defensive market. All right, are we almost there yet? Are we almost through? Do we see the light? Well, there's some good news in the bad news. And what I mean by that is, historically speaking, the larger the drawdown, the better the outlook over the next 3, 6, and 12 months. The equity market is hovering around, the S&P is hovering around the 25-ish% number of drawdown for the year. And historically speaking, over the last 70 plus years, we see on average the next 12 months generate a plus 12% return. And notice that if the equity market drops farther, 25, 30, 35, et cetera, you can see the outlook for the next 12 months gets larger and larger. So that's an encouraging sign from here. Yes, the equity market's volatile. Yes, the interest rate environment is volatile, but the outlook does improve as markets draw down. So hang on, it's a good time to remain invested, even though it can be a little painful to watch along the way. But another tip. October of a midterm election cycle turns out to be one of the strongest months for stocks historically. We've got a few weeks, 18, 19 days left in the month of October. We'll see where it takes us. But we started well, but it's going to be with volatility. But sometimes that volatility can work to our favor. And as the polls get clearer over the next couple of weeks, and it becomes certain that become clearer about who's going to be in charge of which chamber of Congress. We know that there's no presidential or general election this year in November, but this could shape up to be, if the markets are expecting gridlock in Congress, where one political party controls one House chamber and the other political party has the other, that's usually a good recipe for market success. And for markets to have a very strong start their recovery. And we tend to see also post-election rallies towards the end of the year after midterm elections, as some of that political uncertainty gets lifted. All right. That is a wrap on our focus on the markets video for the fourth quarter. It's our last video of the year, or maybe our last video of the year. We may do another one before the year end. But as we round out Halloween here in a couple of weeks and enter the holiday season of Thanksgiving and Christmas, we certainly want to share our thanks and gratitude to you as our clients, as our friends of the firm that this video gets delivered to every quarter. We certainly wish you the best this upcoming holiday season. If anything, Hurricane Ian was a reminder of how special that colleagues and families of colleagues can be here. I know that some people here are certainly impacted with family down in Southwest Florida over at Finspire, and we know that many of you like to spend some time there Also have a lot of friends, family, and other connections in that part of the in the southeast part of the U.S. So just want to take this time to say how fortunate we are not just to be here, but also to serve others, knowing that natural disasters can occur at any time and make a huge impact in the negative way. This is a picture of the corn souffle. So this is one of our favorite dishes for Thanksgiving. My wife makes and my mother-in-law make the corn souffle. It's a big hit at Thanksgiving. So that's another ode to the corn, into the corn maze for this quarter. Thank you so much for listening. We really appreciate you paying attention today and tuning in, and we'll see you all soon. But as we wrap up the corn maze, as we go to the other side, I thought I would finish it off with perhaps the good stuff after you see the path to the exit. Maybe a caramel apple. That's pretty good. Maybe we'll wash that down with some apple cider. But I think my favorite fall delight are these apple cider donuts, and this one covered in maple. Oh yeah, that's the way to go. That's the way to finish the corn maze, and right there with a little cider donut. Hey, thanks so much for tuning in. We'll talk to you real soon.